Good morning. Today is Wednesday, June 3rd, and this is another edition of the Market Commentators, a podcast brought to you by the Milwaukee Company. My name is Matt Salm. I'm an investment analyst with the firm, and joining me this morning is Andy Wilms, President and CEO of the Milwaukee Company, and Mike Wilms, Andy's cousin, who serves on our portfolio strategy and wealth management teams. A quick reminder that nothing on this podcast should be construed as investment advice. And with that, Andy and Mike, good morning.
Good morning.
Good morning, Matt. Good morning, Mike. Hope you guys' day is off to a good start for both of you.
Well, thank you.
Yeah, thanks, Andy.
It's too early for the wheels to have come off.
So, Andy, do you want to lead us off with a quick market recap?
Sure. Let's start with what happened last week. The S&P closed over 3,000. And at that level, it has now recouped 70% of the total losses in the post-February crash. A remarkable move that also, shot the index well above its 200-day moving average. For the month of May, the Russell 300 index, which is kind of a proxy for the entire 3,000, I say 300, excuse me, 3,000 index, which is a sort of a proxy for the entire stock market, was up almost 5.5%. So by all measures, the stock market has staged a remarkable recovery, but the coronavirus pandemic isn't over, and the course of the economic recovery is uncertain, and tensions with China are rising. So we're really entering what CNBC senior markets commentator Mike Santoli called a high-stakes summer. This is really going to be something for the record books for history, I guess I should say, what plays out in the upcoming months, in my opinion. Yeah. So there's also some indications, by the way, that this market rally could come to an abrupt end. You know, we have option traders getting quite aggressive in their bullish bets with the 10-day average of downside put to call volume nearing extreme lows, which kind of suggests that the market may have peaked. The volatility index, which we commonly refer to as the VIX, the 60-day average remains in the high 20s. And when you have an elevated VIX like that, a high degree of volatility like that, when the market is rallying at the same time, that's considered by many to be a sign that trouble is lurking. Usually when markets rallying, the volatility is lower. The yield on the 10-year Treasury is still well below 1%. Which is an indication that the bond market, which many people consider to be the guys participating in that as the smartest guys in the room, as Mike would say, has
being
not
an old
really
fixed income guy myself.
Yeah, that's right. Has not bought into the stock markets. The bond guys don't seem to have bought into the stock market's rosy perspective on what's going to be happening. And then, of course, the other side of that coin is you could be arguing that maybe that's just because the rates are so low because the Fed has decided to keep the Fed funds rate near zero indefinitely. And the Fed has entered into the bond market in a big way, providing a lot of support. And you have the lack of inflation. So when you put those three things together, it might not be that the bond market is pessimistic as much as there's other factors that are overweighing their optimism. And then so far this week, equities still are marching higher despite all the civil unrest around the nations and hopes of increased activity as the economy reopens. Yesterday's gains put the S&P up more than 40% from the late March intraday low. But at this point, it really seems to me, in my view, and view of many Wall Street observers, is that there's a clear disconnect between what's happening on Wall Street and the rest of society and economy, and the economy. And at some point, those two are going to have to reconnect. For that to happen, one of two things will have to occur. Either the market will have to move lower, or the economy and societal circumstances will have to match Mr. Market's rosy expectations. And which of those two will prove to be the case is anyone's guess at this point. If you're guessing that the economy and society will be matching what the market's already priced in, then equities may be an opportunity still in the equities market.
Way to think about that, circling back to your comments about the VIX.
Yeah.
Volatility is essentially a measurement of uncertainty.
Right.
And, there is this huge level of uncertainty that's being demonstrated by how the VIX is trading at an elevated level. I mean, your expectation would be when the stock market is going up, the VIX would be going down.
Right.
And the majority of yesterday was doing the exact opposite. As the market was going up, so was the VIX. So
Right.
it's just, nobody is really certain as to what the future, how that equating of circumstance versus the market evaluation, how that's all going to play out.
Well, and you're absolutely right. And the point being that uncertainty usually is bad for stocks, right? Because people don't want to put all kinds of money into the stock market when they are uncertain about what's going to happen. And when they feel confident, and then you tend to want to invest more. And so it really is a worrisome signal, notwithstanding the fact that stocks continue to rise, And a lot of it's going to boil down to what happens with COVID-19. That's not the only game and only issue. We got China, we've got the social unrest, but COVID-19 is still the primary driver. And I know there's some news there, Matt, you're going to share with us.
Yeah, just that globally, the pandemic's pace has not slowed down at all. There were nearly 700,000 new known infections reported last week. And again, that's just the known infections. So we don't have an estimate for the number of unregistered or unrecorded infections. In the US, things are maybe not as bad as they used to be, but we certainly still have a lot of new infections, and our death toll has surpassed 100,000, which is it's a large number. Do you guys have any thoughts or comments there?
We're under construction here.
Oh, well, I'm glad it was that, Mike, and not something else.
Hey, if that's what you're insinuating, if I was capable of that, I would be in the Guinness Book of Records.
All right, so let's go back to where it left off, okay?
Yeah.
Well, I'm not so sure things aren't worse. I'm not so sure things have gotten better, Matt, because if you just look at what's going on in Arizona, they've had a tremendous spike in cases. I think they had 1,000 new cases yesterday. So in certain parts of the country, the number of cases are actually rising, and moreover, the decline in the number of new cases, if there has been any, which I think there has been some, situation like New York is obviously much, much better, but it hasn't declined as rapidly as we would have hoped or normally have expected with a seasonal flu. So yeah. If you have less decline now, it just only means that the potential is for fall and winter to be much worse than people were expecting. And you also got to deal with the fact that governors and whatnot are much more reluctant to close the economy this time around, right? Because they kind of spent that capital, right? Like when they closed last time, there's only so much time you can be closed without bankrupting your state or on a country level. So they're gonna have to be much more judicious about closing the economy next time, which again means to me things might be actually worse than they were before in some respects.
Yeah, things definitely could get worse in the future, and as we've talked about before, the lows in the market that we saw in March, could be retested. Not saying it's going to happen, but there's a huge amount of uncertainty. Yeah.
Now the good news is on the vaccine front, right? I mean, we didn't have a vaccine or anywhere near close to getting a vaccine the first time around when this all started. So maybe we'll get to the point where we have a vaccine in place when the next spike occurs or before the next spike occurs, and we can control it. We can control the spread of the disease with treatments and vaccines and not necessitate the economy be closed again. So,
and I think that's a good point, Andy, that it's a combination of both the potential for a vaccine and a treatment. There has been some reporting coming out of Russia that they have a potential treatment, and the Moderna treatment is in clinical trials and moving along. So, I think they're working on a potential of up to 140 different vaccine candidates. So, there's a huge amount of resources being allocated to try and make sure there isn't a second wave.
I agree.
Absolutely. Yeah. Then a little bit of international market news I thought would be very relevant, especially given what Jim Cramer talked about yesterday on Mad Money. He made the, I guess, controversial or over-the-top statement that China and Europe are bailing out the U.S. stock market, were his words. But his point being that international economic activity is picking up in some places. For example, in China, auto sales bounced 11% last month, and GM actually sells more cars in China than it sells in the United States. And so for a lot of major American companies that do a lot of international business, if things are improving in other locations around the world, such as Germany or China or other major economies, then stocks in the US might climb higher, even if the US economy isn't in great shape.
Well, I think everybody needs to keep in mind that over 40% of the revenues of the S&P 500 are international in nature. I mean, and whether it's developed, which would be Europe, Japan, or the emerging markets, a large percentage of overall revenue for the S&P 500 is generated on a global basis.
Then, Mike, do you want to give any information or interesting stories on the macroeconomic or bond market front?
The Bloomberg Commodity Index was up 11.1% in May. A big part of that is tied to the recovery in the oil markets. This morning, Brent, which is the European benchmark oil price, broke over $40 for the first time in months. It's been a pretty amazing snapback in oil prices for West Texas Intermediate to be back in the $35, $36 area after having traded below zero back in late March is really pretty amazing. We talked a little bit about before we got on the podcast some of the GDP forecasts for the second quarter. There are some pretty amazing forecasts for potential GDP declines in the second quarter. The Atlanta Federal Reserve is projecting up to a 53% annualized decline for second quarter GDP. That sounds very devastating, but I would think that it would be hard for the economy to continue to contract if in fact a number anywhere close to their current forecast is reality. And you would expect that the economy would start to recover and grow once the third quarter would begin. So while the numbers initially sound pretty bleak, there is a silver lining, at least all things being equal. So Andy did point out, interest rates remain at very, very low levels. The 10-year at 68 basis points, less than 1%. I mean, there's no other way to describe that other than historic. The impact of the Federal Reserve programs is really starting to be felt. The corporate bond market, both investment grade, non-investment grade, started to recover long before the Federal Reserve implemented their ETF fixed income purchasing program. Bond prices have recovered, yields have dropped. Some of the support for the economy that was contemplated by the Federal Reserve has really taken effect and been a benefit for the country as a whole.
Yeah, or at least the markets have benefited, and the thought is it will spill over and benefit the economy in very short order. All right, hopefully
Exactly.
we see that pick up. Yeah. I guess we'll move on to the last segment of the show then, where we bring it back to the individual investor and what you might do with all of this information and some considerations that you might have for your own individual portfolio. We've already talked about this a bit, but Andy, do you want to reiterate a few things on why the stock market maybe has been on such a tear?
Well, just real quickly, I mean, when this whole thing started and the market really tanked, there was a lot more dire outcome. The possibility for really, really dire outcomes was greater. And so the range of potential outcomes was greater, and what might happen, we really had a lot of uncertainty. Now it appears to many that the worst, notwithstanding the concerns I raised earlier, the worst case scenarios that we're envisioning now seem to be less negative than the worst case scenarios that were being envisioned back in March. And so as the worst case scenarios become less extreme, the market it creates a basis for recovery. But of course, that means that the market could re-enter a bear market if one of three things were to happen, right? You could either have something happens to make the really bad outcomes as severe as originally feared, like we find a vaccine just can't be developed. That was one of the really bad outcomes before. Right now, it seems pretty clear you can treat the disease. They will eventually have a vaccine. It's just a matter of when, not if. But if something dramatic happened, we couldn't control, with the vaccine, that would drive the markets lower. Or if something happened to make the most likely outcome seem worse, that would also drive markets lower. Or something to make the best case scenario less positive, right? The best case scenario right now is we're back to where we were before this thing hit in relatively short order. And that's sort of where the NASDAQ is, right? It's like 2% down from where it's all-time highs. But if something happens to make the best case scenario less positive, that too would drive the markets lower.
Another topic we've talked about, in addition to stock markets being on a tear, is inflation.
Right.
There are loads and loads of opinions on inflation. All sorts of different models, I guess classical models, would suggest that inflation would increase when you've got this amount of stimulus, fiscal and monetary stimulus. Is this still an active area of concern for you?
Well, yes and no. I mean, I think I've been consistent in my view that for the most part, immediate inflation is not a risk because demand is so low. People are not spending nearly as much as they had been. And you're not going to have inflation with diminished demand, right? You got to have demand to push prices higher. And the financial markets reflect the fact that the expectation is inflation will remain low. But there's in the short term, but there are significant reasons to be concerned about what will happen with inflation going forward. Because for example, it seems like big companies are going to have more pricing power than once this dust settles and be in a position to raise prices more than they have. I think a lot of people underestimate how important globalization has been to controlling inflation, right? And free trade and that sort of thing. If that globalization reverses, that would be a driver for inflation. You have the rise of populism in rich countries, and that's kind of hard to square with endlessly low inflation. And you got this whole notion that fiscal stimulus has now become a tool that countries are much, much more willing to use than they were in the past.
Even the Germans, who are historically,
Exactly.
penny pinchers, they're looking to open up the purse. So.
Yeah, and, I think we heard Japan and France both announced big stimulus programs yesterday or the day before. So it's the more the government debt piles up, the more tempting it is for governments to solve that debt problem by inflation, just like Germany tried back before World War II. I owe you a bunch of money. Well, I'll just make sure my money isn't worth as much. I'll pay you back on pennies on the dollar by making the dollar worth a penny. I don't think we'll do that, but you see, those are all things in my mind that could be long-term reasons to concern about inflation. Mike, what do you think?
I'm kind of circling back to Milton Friedman and his philosophy around inflation always being a monetary phenomenon. I think your points are well taken about globalization and bringing low-cost labor into the production and how that affects pricing. I mean, if I went and bought a pair of underwear today at Walmart, it would have been manufactured in Bangladesh, and it would cost me the same as it would have cost in 1980. I mean,
which is the last time you bought underwear.
I think the inflation part of it, when you're thinking about the amount of cash that the Federal Reserve is pumping into the economy, is going into asset purchases, and that's where the inflation is on the asset side of things versus on consumer goods.
Yeah, well, yeah, that's true too.
So
speaking of asset prices, do you want to talk a little bit more about the impact of inflation on stocks, Andy?
Well, stocks can be thought of by usually as a decent hedge against inflation in the long run. But over shorter horizons, rising inflation also leads to falling stock prices and vice versa. So again, it depends on your time frame.
Any other closing comments then, or advice for individual investors?
I would just tell you really have to focus on your tolerance for risk right now, and that should be really what guides you. Be very careful of controlling all of us have sort of a greedy nature, and when the market goes up, we all want to participate. We hate being left out. I do as much as anybody, but you have to control that by knowing how much risk am I really going to take, because whenever the market goes up, risk goes up with it, especially now.
Yeah. All right. Well, thank you guys so much for joining this morning, and thank you everybody for listening. A reminder that if you enjoy the podcast, you can like and subscribe on YouTube, on Spotify, or wherever you get your podcasts. You should also follow us on Twitter at The Milwaukee Co. if you want to stay up to date with our thoughts and perspectives. And we have a weekly newsletter that comes out every Friday where we share commentary on a wide variety of issues in markets and the economy. So Mike and Andy, thank you again, and I hope you guys have a good rest of your day.
Well, I think I will. It's a beautiful day. I think it's a good day to hop on one of my old British motorcycles. Mike and I share a passion for old British vintage motorcycles. I think maybe we'll take the Norton Commando for a ride out before the day's done.
Well, enjoy. So Matt, have a good day. Andy, take care, and I'll talk to you guys later.
Okay. Bye-bye.
Bye-bye.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.